The open banking funding model is one of the most controversial topics in the industry. Open banking requires significant investment in technology, but also in the broader ecosystem to manage the transfer of data, to manage standards, and potentially to manage a payment scheme. So what are the two views? Well, on the one hand, we have the commercial model. On the other hand, we have the regulatory intervention model. The commercial model says that all of the ecosystem participants should bear some of the cost of building the technology and running the system. In that case, fintechs who are generating revenue from open banking should pass some of that revenue back to the banks who are building the core infrastructure. All seems quite logical, and this is generally modelled on the card scheme interchange approach. On the other hand, we have the regulatory model, which says that, okay, this is a competition remedy. Banks have too much power and we need to support new entrants who are going to be able to transfer value to consumers and businesses. In that case, those fintechs who are transferring value shouldn't have to pay for the development of the open banking infrastructure. Both of these areas have weaknesses. On the commercial model, the greatest challenge that the model has is what exactly should be the cost that's passed back to the banks? Should it be the cost of building the technology, which in some cases is quite difficult to measure and really depends on how efficient the bank is? Should it be an effective replacement cost to cover the lost revenue from offering new products like payment initiation, for example, which cannibalizes card revenue? These are quite difficult to areas to cover because in both cases it's highly likely that the cost passed through to the fintechs would mean that there would be no advantage or no value passed through to the end businesses. And then what would be the point of open banking? On the other hand, the regulatory model comes into a bit of difficulties when we look at incentives to continue to innovate. In the regulatory model, banks have to shoulder all of the costs and therefore have an incentive to do as little as possible and not drive the industry forward. Now, in both cases where there is so much cost being passed through to fintechs that they can't produce products, and in the case where banks have no incentive to continue to innovate, we reach a place where open banking doesn't fulfill its potential. Therefore, I strongly believe that we'll need to reach a place in between both that has some aspects of a commercial model and some aspects of a regulatory-driven minimum. This is a topic that isn't going to go away, and it's a topic I'll be diving into in a little bit more detail in other videos. Thank you for watching. My name's Kieran O'Malley.